Hey everybody, happy Wednesday. I had to check what day it was. This story today is a little bit different than normal, but it stems from inspiration that came in from a community member who asked a question about the relation from a community member. Let me turn that. You got volume, is good. Which actually others chimed in and were concerned about the actual future, where the money is, where it's going, the correlation between that and inflation. We just had the Fed meeting today, etc., etc. We're going to walk through a whole bunch of data. We're going to look at demographic pyramids. We're going to look at wealth pyramids, and we're going to figure out where the money is and where it's going to go. Will there be an abundance in the future? Well, some weird things are happening out there. So first of all, not financial advice, doesn't really apply to this particular video. And the inspiration for the video came from JoelG. And it became an expansive story into wealth and demographics. And ultimately, at the end, there is hope. But let's dig in a little bit. The question was, with the baby boomers being the largest wealth generation plus controlling a large percentage of the wealth, how do you think their retirement affects inflation for the coming years due to wage growth from a labor shortage? And this is kind of interesting because it ties together all the stuff that we see happening right now. We had the Great Resignation and then the quiet quitting, and how different cohorts of society are kind of upset with each other. A lot of this was accelerated due to the pandemic. And there are societal factors, inflation, debt, etc. And many of the community members in this channel are actually millennials as well. And all across the gamut, all the way up to people who are 85, 90 years of age. And the community members are very passionate, so I'm speaking for them. I speak for everybody and help us try understand where all of this is going. So first of all, quick reminder as to the population categories. We have the baby boomers born between 1944 and 1964, and they're currently between, say, 55 and 75 years of age. And there's 76 million of them. Then the Gen X, born between 65 and 79, and are currently between 40 and 54 years old. 82 million of them. I fall into that category myself. Gen Y, or Millennials, were born between 1980 and 94, actually between 25 and 39 years of age, and that's why Gen Y and Millennials synonymous. And then you have different versions of Gen Y, and then you have Gen Z, the newest generation to be named, born between 1995 and 2015, and they're currently between 4 and 24 years old, approximately, give or take a year or so. I can't remember the exact numbers. So the breakdown in the United States, which is somewhat similar to the rest of the world, but basically it's even quarters and evenly spread. But there are some changes going on. We have the boomers, about 25%, Gen X, 26.9%, Gen Y, 24%, and Gen Z, 24.3%. So it's a nice breakdown. Maybe that's by design, but there's some stuff going on. But first, let's look at who's got the money. Boomers are 24% of the population, but own 60% of the wealth. And that's a staggering statistic. And millennials have less than 5%, despite being the largest working population and largest real salaries. So what's up with that? Another visual. I've shared this one before, but put another way, if you combine the silent generation with the boomer generation, those two together own 3/4 of all the wealth in the United States. And it's similar in other countries. I'll show some other country stats as well as we go forward. But that is crazy. Silent generation hold about 15%. Boomers, nearly 60%. That's where that number comes from. So what does the wealth look like per capita, per person? And this is kind of puts it all in perspective. You can see here that the wealth distribution, the biggest chunk is with baby boomers, 59.4 trillion. The average wealth per person between a silent generation person and a baby boomer is just over $800,000, but the combined wealth is staggering. The Gen X wealth per person is about 440,000 on average, and the millennials about 68,000 on average. So people are also interested in where they fit within the world. But again, these are averages. They're not median numbers. So let's look at some UK numbers as well to see how they compare. And here you can see the different wealth concentrations with boomers as well in the United Kingdom. This chart is from the ONS Wealth and Asset Study. And it's part of a book that looks at wealth by generation in the UK from David Willett's book called The Pinch. And we will be referring to some books here because a lot of great work has been done. And this chart shows the massive concentration of wealth among the boomers, particularly in the form of pension, welfare, property, wealth. We'll talk more about property and real estate as well in a few minutes. But for Millennials and Gen Z, they have no real access to pension benefits, obviously, because of their age. And that makes up the biggest portion of some boomers' wealth as well. And when Millennials and Gen Z entered the workforce, employers have long ended the pension programs that these boomers enjoy. And that's a big problem that's pointed out in this particular book as well. So let's look at the question that JoelG had before we get into a lot more other stuff that was triggered by this research. And again, it's a tricky subject, but I tried to build out the estimated age cohort effects on inflation. In other words, it's called inflation dependence. And again, it's really, really a tricky one. There's a lot of study been done on it. I've read a couple of papers in this subject. But inflationary pressures rise when the share of dependents increase, and conversely, subsidies when the share of the working age population increases. And this relationship accounts for the bulk of trend inflation, which doesn't include inflation driven by things like oil, etc., which we're experiencing now, but trend based on the age of different cohorts that are out there. And about 7 percentage points of US disinflation since the 80s, and it predicts rising inflation over the coming decades going forward. But what I did was I took this and tried to explain it in more simpler terms. And those that are aged between, say, 25 to 55 years of age, they're too busy to spend money, but they make the most money. They're in their prime earning years, so particularly those between, say, 35 and 50. That's when all the big money is actually made for folks. But they're too busy to spend it. I call it the too busy to spend zone in the red box there. And then you have, to the right, you got the green box, which is the spend zone. This is when people hit, say, 50, 55, 60, 65, 70, 75. And they're like, whoa, okay, I've got this money in the bank. Should I start ticking off some bucket list items? Should I go on that safari to Africa? Should I buy that sports car? Should I get that rental home? Should we eat these fancy meals or buy whatever watch, etc.? That's where the spending happens, and that's done by those demographics there. So JoelG, that is the answer to your question, but there's a lot more to it. So let's jump into more demographics before we go into the crux of this Pandora's box of a story today. So the world is pink and turning blue. So what pink means is the birth rate is between 0% and 1.5%. And again, it all goes back to demographics that predict a lot of stuff. There's definitely strange stuff happening in the world. I remember being in Italy in the early 90s, in Milan, and my peers down there were not having kids nor had any plan to. And I was a lot younger than my peers at the time. My peers were 35 to 40 years of age. I was in my 20s. And they wanted to party, have nice condos, have nice sports cars. And that was their lifestyle. And I didn't understand that. But if you look at the blue on the map today, all the heavily predominant Catholic countries, Spain, Italy, etc., and Central Europe is blue or dark blue, which means there is a negative birth rate. Okay, now this negative or zero natural population growth means that these countries have more deaths than births, or an even number of deaths and births, which means population is flat or declining, which is a big issue that many people have spoken out to. Now, if you look at the hot red areas, these are places where there's a lot of growth in population. It's places like all across Africa, like Angola. You have Iraq, very red, Oman, very red. And these places are the only ones having the most babies. Even other parts of South America are no longer having as many babies as they used to. But let's look at certain types of countries, because this is a concern, and this has an impact on where things go, depending on where you are in the world, what cohort you belong to, and how much there will be there for you down the line. So let's look at one example first. Two very distinct countries, South Korea and Angola. You can see this is what's called a pyramid, population pyramid. And it basically starts at 0 and goes all the way up. And having a thin bottom is not healthy. And a big bulbous middle is where all the people kind of are. And what is healthy is the one on the right. That's Angola. You can see lots of babies and population grows up. But people obviously maybe don't live as long in Angola. I'm not sure for the reason for this, but this is their pyramid. It's a substantial country with 35 million people. Republic of Korea has 51 million people. And again, nobody there is having babies. And this goes to the whole issue that policymakers and what some people refer to as the welfare state, there always has to be more young people supporting fewer older people. But that's no longer the case in the world. And let's go through some other examples of where having a kind of top-heavy, bulbous shape, it's not a pyramid, I don't know what you call it, like a pear or something, is not good. So let's look at some where the two biggest audiences of this channel are, United Kingdom and the United States. In fact, you can see unhealthy for both, but even the UK is having less babies than the US. Again, that's the skinny bottom for the UK. It's even thinner than the US. Let's look forward as well. Let's look at Italy versus the Netherlands. You can see Italy there, 60 million people, really thin at the bottom. Really, really thin indeed, just like the South Korean story we saw before. That's very, very unhealthy. Netherlands, same thing. And anywhere you go across Europe, you know, France, Spain, Italy, Portugal, Germany, it all looks just like this. So there's no point in putting the charts on because they all look the same. Now, getting back to business, let's look at millennials. Currently, they only own 5% of the wealth. And the big story is not anything else other than that, but having that 5%. And this is people 41 and under. And the boomers, as they age, their wealth is growing. But this is a big problem. I'm trying to read the text here. When baby boomers were under 40, they held 13% of household wealth compared with just 5.9% for millennials under 40 today. And that's a big difference. So let's crunch a little bit of numbers here and look at where the wealth is concentrated by the big cohorts. You can see red is baby boomers, 53%. And older, you got your Generation X, 25%. You have your silent generation and older, 16.8%. And then your millennials right now, per this number, different source of data, is 4.5%. So it's stunning. And it's changing all the time as well. Because as assets inflate, with the inflation era we're in, things change. People who have a lot of hard assets, their wealth goes up a lot faster. So let's look at another view of this. This is the wealth gap on real estate. So a different perspective. I always stress on this channel, have the three-legged stool, real estate, crypto, and disruptive stocks. But here the wealth gap is especially apparent when we look at real estate wealth accumulation over time. And home ownership is radically concentrated in the hands of boomers, and their net wealth has consistently benefited from the value of their homes going up as they have gotten older. And meanwhile, millennials can't even seem to get in the door right now, especially with our very high mortgage rates above 7%. That basically puts a lot of people out of contention. And meanwhile, while this is happening, you've got companies like, it's not BlackRock, it's the other one, but they're buying up all the real estate and they're jacking rates on people who are millennials. Let's talk about rent for a second. Millennials today are in their prime home buying years, aged 25 to 40. And as such, their home ownership rate has increased faster than any other generation over the past decade. However, in 2021, millennial home ownership rate stood at 48.6%, up from 30% in 2011. That was after the great global financial crisis, where the real estate market just fell apart. But despite steady increases, millennial home ownership still significantly lags behind older generations. For Generation X, 41 to 56, the home ownership rate is over 20 percentage points higher than that of millennials at 69.1%. And you can see they are very, very far behind. Also, the fact that 48.6% of millennials own homes, it means the majority actually rent, which is a problem too. So this is the trailing gap of home ownership for millennials, and you can see the purple line is millennials, and they are way under where Generation X was at this particular age group. Of course, it cuts off at 40. That's the age group right now. But here, that is a stunning chart. And what's also more troubling is it's going down, and it's going to go down further with the very expensive mortgage rates that exist that put houses out of reach of many. And that is a big, big issue as we go forward. So let's talk about what happens. Again, as I always say, get hard assets. I don't care what they are, but hard assets appreciate. And the boomers are getting wealthier and wealthier because they own a lot of hard assets. They own real estate, they own stocks, etc. And that can be illustrated here, where the wealth of the generations by age has gone up. Those 75 plus, it's gone up 100% since 1989, 65 to 74. It's gone up by 75, 78%. And those 55 to 64, it's gone up a little bit, but not too much. All other demographics are down, which is a problem. Now, as house prices go up, rent is also going up. We just covered home ownership with all the different cohorts. And you can see here, boomers benefit technically from rising home prices and rising rents at the expense of millennials, because they rent their homes and apartments, etc., to millennials and Gen Z. And 20% of boomers rent out their second home. And often it's the millennials and Gen Z that are paying rents, therefore making them richer. And there's kind of a whole spiral effect here. That's the other reason I try and incentivize people to buy real estate, so they can jump on this so-called property ladder. And one of the most stunning statistics was, thank you to a community member for digging this up. This one kind of blew me away, but more millennials now live with parents than ever before. Now, I know we had a pandemic. We haven't even seen 2021, 2022 levels, but I have noticed there's been a change in the type of real estate that's been built. It's multi-generational real estate, where you can have grandparents and parents and children all in the same house. That's becoming more and more common, and I've never seen that in my entire life. But here, millennials, since they are not renting, they are likely to be living with their parents, with the number of people aged between 18 and 29 living with their parents at an all-time high, even higher than 1940 during World War II, which is a very stressful time. So staggering stat. In addition, this one was another piece of sad news. This looks about prospects and opportunities by cohort. This is a chart of GDP growth for the first 2 decades of entering the workforce for each generation. And that assumes that everybody gets a piece of the GDP growth. When things are booming, everybody does well. But millennials by far have had the worst prospects in the first 2 decades in the workforce compared to the past 3 generations. For the past 3 generations, the first 2 decades were periods of high economic growth, but millennials, on the other hand, spent the first 2 decades of their careers in periods of economic stagnation and decline. Think global financial crisis, think dot-com bust, etc., etc. Now we're in a third one, 3 and 20 years, pretty staggering. And this translates to more time getting laid off, being unemployed, and less productivity, less earning chances, less chance to get on the property ladder. So on this chart here, I added 3 up arrows showing the GDP growth for the silent boomers and Gen X generation. And then you see the millennials from 2000 onwards. It's been kind of flat and stagnant. And that takes a toll, everybody. But wait till the end. There's some good news coming. So tenth of all at this stage, these are 2 charts from Scott Galloway's book. It's called America Adrift. And the chart on the left shows the percentage of 30-year-olds that earn more than their parents at the same age. And that is, right now, less than half. Interesting. But meanwhile, it's costing millennials and Gen Z more in the form of education costs to maintain their earning power. And per Scott Galloway, 40 years ago, 1 in 3 jobs needed a college degree. Today, it's 2 in 3 jobs. Therefore, people have to go to school, and that costs money. And the average cost of a college degree has far outpaced the earnings growth for young people. In 2019, the cost of a college degree was 150% of average earnings, 3 times more than what people were making 20 years ago. And millennials and Gen Z are saddled with the cost of education yet not making enough money to justify the poor return on the investment. That's why I've also been vocal that sometimes, you can learn what you need to learn on things like YouTube. You don't need to go to college if it's going to cost you $50,000 a year for 4 years. That's a huge amount to invest, and you may not see the return on investment for a long time from that. Not saying college is bad, but just sharing that from a numbers perspective. Also, this is a piece out of the UK, also from Scott Galloway, and this is the UK's tax structure and how it benefits different age groups. So when you are, the worst people that benefit are between the ages of, say, 19 and 23. They get hammered from tax policy. They don't get any benefits. But notice, you start getting benefits once you start going above 45 years of age. And that is the interesting story here. Net tax benefits by age. The younger you are, the more negative it is. And the older generations are net positive. And this also is reflected sometimes in the United States. For example, capital gains, mortgage interest disproportionately benefit boomers because boomers own stocks and they own homes. Again, all related to age, tax, hard assets, income, etc. And this is another big problem. And some people I remember somebody saying to me, but mortgage interest in the United States is tax deductible. It's not in Europe. And I was like, it's like middle class welfare. It's exactly what it is, and that's reflected here in these numbers. Let's look at the UK, another UK statistic. This is another chart showing the lifetime benefits of where they are allocated. As we can see, boomers are going to withdraw for far more out of the system compared with millennials and Gen Z. Per Scott Galloway, each year, millennials and Gen Z transfer $1.5 trillion worth of wealth to the welfare system that's transferred to older generations. And this system, according to Scott Galloway, not me, is set up to where boomers are always net beneficiaries, while younger generations are net losers. And that was strong words from him. Final slide before I get to the conclusion. The other key aspect of all of this, why maybe the tax structure in the UK, etc., and here is beneficial, is power is concentrated in the hands of the boomers. This recently changed in the UK with their new prime minister. He's only 42, but the average age of US Congress continues to make all-time highs. The boomers enjoy the greatest representation of all age groups in the House and the Senate. And as for the presidency, we've had 5 successive boomer presidents going back to 1993. In fact, 4 of the last 5 presidents were born within 4 years of each other. You can't make that math up. And that's why we have President Joe Biden now. I think he is turning 80, if I'm not mistaken, in a couple of days, or just did, or something. But his birthday is coming up. Anyway, 80 years of age. So let's talk about conclusions for a second. Let's look at the global wealth pyramid first. Before we go to the breakdown, first of all, this is the global wealth distribution in 2021, and it's staggering. Obviously, the top 1.2% of the world's population have greater than $1 million in wealth, and it's about 62.5 million people. Then the next tranche has 11.8% on between $100,000 and $1 million, etc. And as we go down, we can see it gets grimmer and grimmer. Nearly 2 billion people own between 10,000 and 100,000, and another 3 billion own less than 10,000, 53% of the population. And that shows you, although we showed there's a lot of wealth concentration within the older generations, that concentration is not only concentrated within the older generations, but within a small percentage of the older generations as well as we go forward. In addition, another view of this, a more drastic view, is the difference between income and wealth. Income is what you get in your paycheck. Wealth is what you have. Again, going back to hard assets. And the pandemic wiped out years of progress in reducing poverty around the world, and it caused economic inequality to spike. And the world's 10 richest men have doubled their fortunes in 2 years since the global health emergency. And while the incomes of 99% of humanity are worse off as a result, according to a British company called Oxfam, and more than 160 million people have also been pushed into poverty, of nearly 8 billion in population. And that is staggering. So let's look at some high-level statistics, and then I promise I'll finish on a little bit of hope. So first of all, millennials have 300% more student debt than their parents, which is staggering. Second, home ownership for millennials They are half as likely to own a home as young adults were in 1975. But don't give up hope. It's always possible. And then third, 20% of millennials are living in poverty in the United States. And poverty refers, it's important here as well, because the definition of living in poverty has changed a little bit. This refers to the bare necessities of life, of food, clean water, shelter, clothing. But now the definition of poverty is extended to access healthcare, education, and even transportation. And a lot of people don't have healthcare in the United States, and that's why this number is so high. So don't be too perturbed by that, but I just wanted to clarify that number too. Fourth, this is the expected retirement age of a millennial working today. 75 years of age. And again, when I go to a store like Walmart or whatever, I can see people at the checkout who are above 75. It's just heartbreaking to see. So let's talk about why the problem is, and is the system unsustainable? So it is not sustainable. We have this welfare system and entitlement programs that were designed with the assumption that we would always have more young people to support the few older people, and that each generation would always become richer than previous generations. But the problem is people are living a lot longer and people aren't having babies. But hence the importance of looking at the demographics at the beginning. So none of this system holds true. It's not sustainable. Demographics, societal factors, inflation, debt has all turned the system into a house of cards. And millennials and Gen Z have to shoulder more and more as the boomers leave the workforce. This is a problem. They have to prop up the system, paying for an increasing share of the welfare state. And getting back to JoelG's question, you can see how it's all related. All the stuff like debt, demographics, inflation. Again, any increase in wage due to labor shortage will be captured by increasing costs in home prices and rent, which the boomers will benefit from. And the system is unsustainable. Millennials and Gen Z are frustrated, and they're fed up with the system too. And we're beginning to see much more of a kind of an opt-out generation too. So we're already seeing generational conflicts in places like China and Japan, where the generational imbalance is particularly bad. Remember this chart's at the beginning, even take South Korea. And then you have a movement like lying flat in hikikomori, popping up in younger generations as well in Asian cultures. And in the US, we have quiet quitting and great resignations and everything else. So that's the problem. But I did promise you a hope slide, and here it is. So this is what we're setting up for. There is some hope. Over the next 20 years, it is expected $68 trillion of assets will trickle down through inheritance to millennials and some Gen X. And the global wealth is $500 trillion, and US boomers own about 13.6% of it, 14%. So it's hard to imagine, but it's true. Boomers born between 46 and 64 are expected to nearly account for 2/3 of the wealth transfer in a coming era that will witness the most dollars changing hands in the United States and any other country, because they're all the same, they're all in the same boat wherever we go in the world, has ever seen. Just put that in perspective. 68 trillion is enough to pay 20 million teacher salaries for 100 years. And also, millennials and Gen X like crypto. And I do believe that a big percentage of this money that will be inherited will flow into crypto on top of all the adoption. So the hope message here is get some insurance, get some Bitcoin, because this thing's going to appreciate. If you can't get hard assets like houses and stuff, get some Bitcoin. So strange story today, but again, we work for the community. This question came up. It was a tricky one. And of course, I went off on 20 different tangents, but I hope you enjoyed it. There's something in there for everybody. Okay, so thank you, team. Be safe out there, no matter what cohort you're from. If you're a boomer, silent generation, Gen X like myself, a millennial, and everybody else in between, be safe out there. Talk to you tomorrow. Bye.